This is Alpha, a unique perspective to observe the market. Let's go to the pre-market observation of the U.S. stock market on June 3, 2025. Let's start with market review. In the last trading day, the U.S. stock market rose overall, with the Nasdaq Composite Index performing the strongest, up 0.7%, the S&P 500 Index up 0.4%, and the Dow Jones Industrial Average up slightly by 0.1%. The market continued to maintain a positive trend after a strong performance in May, with all three major stock indexes close to historical highs. Despite the escalation of U.S.-China trade tensions, investors remain optimistic about future trade negotiations. U.S. Treasury yields rose slightly, with the 10-year Treasury yield reaching 4.461%. The U.S. dollar index weakened, and the euro, pound and yen all strengthened against the U.S. dollar. International oil prices rose 2.8%, affected by Ukraine's drone attack on Russian military airports, and OPEC Plus decided to increase crude oil supply from July. In terms of precious metals, gold prices rose and silver prices also rose, reflecting the rising demand for safe haven assets driven by geopolitical tensions. The intensification of the conflict between Ukraine and Russia and the U.S.-China trade friction are the main factors driving the price of gold and silver. Fixed income markets performed positively last week, with U.S. Treasury yields falling, especially the 10-year yield, which fell 11 basis points to 4.4%. Both investment-grade and high-yield corporate bonds performed well, and risk assets rose overall, and market expectations for the Fed's recent rate cuts have weakened. Municipal bond yields fell, capital inflows were stable, and supply remained healthy. Next, we move on to macro analysis. First, come to today's market hotspot observation. The first news. According to MarketWatch, a previously underappreciated provision, Section 899, in President Trump's recent tax reform and spending bill may open a new front in the global trade war and directly hit your wallet. The provision authorizes the White House to impose a so-called revenge tax on U.S. assets, including foreign holders of U.S. Treasury bonds, which may further push up interest rates. The current reference value of the U.S. 10-year Treasury yield is 4.451%. If this revenge tax provision is implemented, it will be a blockbuster in the global capital market. It may significantly reduce the willingness of foreign investors to hold U.S. assets, especially Treasury bonds, the global safe anchor, trigger capital outflows, and push up the financing costs of the U.S. government and the overall economy, that is, interest rates face upward pressure, which is a blow to the U.S. bond market, which has recently improved slightly. For the stock market, rising interest rates and the risk of escalating trade wars are both substantial negatives, and market uncertainty will increase sharply, which may cause investors to reassess the risks of U.S. stocks and U.S. dollar assets. This is a big deal. Once it lands, the impact on the market is difficult to estimate, and we must pay close attention. Impact rating, 2 stars. Second news. According to CNBC and MarketWatch, stock index futures fell after the S&P 500 index rose modestly on the first trading day of June. However, MarketWatch also quoted analysts as saying that the stock market is expected to continue to climb in the summer because the market breadth, that is, the range of stocks participating in the rise, is improving, which is usually regarded as a bullish technical indicator. The so-called sell and leave in May does not seem to apply this year. After the turmoil caused by tariffs in April, the rapid rebound in the stock market surprised many investors, and some people believed that this good momentum would last at least until the summer. The decline in short-term stock index futures coexists with the optimistic outlook based on the medium-term outlook based on market breadth, reflecting the game between the market's short-term risk aversion and medium-term technical confidence. The decline in futures may be affected by breaking news, while the improvement in market breadth suggests potential endogenous upward momentum. This divergence shows that the market is unclear in the short-term direction, but if the breadth continues to improve, there will still be support in the medium term. Impact level, 1 star. The third news. According to Yahoo Finance, Fox Business and CBS News, Sino-US trade tensions have re-emerged. U.S. stocks were under pressure in early trading on Monday. It was reported that President Trump was waiting for a call with Beijing, but the tension had already escalated. China countered and accused the United States of undermining the trade agreement through measures such as export controls on AI chips and restrictions on student visas. The European Union also issued a warning about the current trade situation. The current situation shows that President Trump seems to be stuck in the stage of waiting for Beijing's response again, and Sino-US trade relations have fallen into high uncertainty again. The mutual accusations between the two sides about the other party's failure to implement the agreement cast a heavy shadow on the development of the trade war. I think this situation shows that the two sides may be accelerating towards decoupling. The previous so-called agreement or truce is more like a stopgap measure. The signal received by the market is that decoupling may be inevitable. Although U.S. Treasury Secretary Scott Bessent tried to appease the market, saying that the leaders of the two countries may have direct contact soon, combined with past experience and current details, this is more like Bessent's unilateral optimistic speculation, and the negotiation process is destined to be bumpy. If this decoupling expectation spreads in the market, it will have a long-term and far-reaching negative impact on the global supply chain, multinational companies and overall market sentiment, and risky assets will face revaluation pressure. Impact level, 3 stars. The fourth news. According to Bloomberg and MarketWatch, gold prices continued their recent strong rise as trade concerns triggered safe haven demand. MarketWatch reiterated its bullish view on gold, noting that after breaking through the key technical cup handle pattern of $2,100 in early 2024, gold prices continued to rise and broke out relative to the S&P 500 and the 6:4 stock bond combination. This multi-year bottom breakout technical pattern is highly similar to the pattern that gold launched from $500 in the early 2000s, suggesting that even though the price has nearly doubled in the past 2 years, there is still considerable room for gold prices to rise. Tariff-driven, Sell America, trading logic has further supported gold demand. Gold's strong performance is a direct reflection of the market's high-risk aversion, especially against the backdrop of the looming trade war and increased geopolitical uncertainty. Bullish signals in technical analysis and potential capital flows from Sell America have provided support for gold prices. Continued strength in gold usually means that investors' confidence in risky assets such as stocks has declined, which is a negative signal for the stock market. Impact level, 1 star. Fifth news. According to Fox Business, Wall Street Journal and Yahoo Finance, J.P. Morgan Chase CEO Jamie Dimon once again warned the market, saying that the market was complacent and that surprises might happen in the future. He was mainly concerned that the ever-expanding U.S. national debt might trigger turmoil in the bond market, and stressed that the United States should focus on its own challenges rather than worrying too much about China. He also said that he had no plans to retire in the short term. Recently, Jamie Dimon has frequently warned the market. After years of his continued pessimistic rhetoric, the market seems to have developed a certain immunity to some of his remarks, so the marginal impact of his warnings may have declined, and the market is still strong. On the one hand, this may indicate that there are no major negative factors in the current market that are enough to cause panic. On the other hand, it is also thought-provoking. Is this banking giant repeatedly emphasizing risks because he has foreseen some deep concerns that have not been fully priced by the market, or hopes to send some signals to regulators or the market in this way to maintain a certain stability of the financial system, or to pave the way for the risk management strategy of his institution? Although the market may be blunted by Dimon's wolf cry warning, his continued attention to U.S. debt and bond market risks is still a long-term risk point that investors cannot ignore. If his concerns become a reality, the impact on the entire financial market will be huge, and we should remain vigilant. Impact level, 1 star. The sixth news. According to Fox Business, with the U.S. debt ceiling deadline approaching, U.S. Treasury Secretary Scott Bessent publicly stated that the United States will never default. This is a necessary reassurance to the market by key government financial officials during sensitive periods. It aims to dispel market doubts about the U.S. government's ability to repay its debts and avoid unnecessary financial panic. This statement will help stabilize market confidence in the short term, reduce the credit risk premium of U.S. Treasuries, and provide a short-term positive for the stock market, bond market, and the U.S. dollar. Impact level, 1 star. The seventh news. According to MarketWatch, despite the continued pressure of the Sino-US trade war and the tightening of US restrictions on advanced chip sales, analysts are still optimistic about the hardware demand of China's artificial intelligence industry, believing that this will bring opportunities to US companies such as NVIDIA. Analyst Jeffries pointed out that China's cloud service providers have strong capital expenditure growth, even surpassing their US counterparts in the first quarter of 2025, showing their continued investment in AI hardware. NVIDIA is expected to launch new, compliant, chips to continue selling to the Chinese market. Amid tense trade relations, this news has brought a glimmer of hope to certain US high-tech companies, especially AI chip leader NVIDIA. The huge demand in China's AI market and the ability of US companies to adapt to regulation by adjusting product strategies may hedge geopolitical risks to a certain extent. This is a positive factor for the stock prices of related companies such as NVIDIA, but its positive effects are mainly limited to specific sectors. Impact level, kernel level. Based on the above earlier macro news, the macro outlook for today's market is stable and slightly negative. Next, we will analyze the stock, bond, gold and cryptocurrency markets to feel the overall market sentiment and capital flow. Although threatened by the tense Sino-US trade relations and the doubling of steel and aluminum tariffs, investor sentiment in the stock market is still relatively stable and maintains above the sentiment center. The amount of active funds is still sufficient, but there is still a lack of some substantial reasons to break through the recent price highs. Investor sentiment in the gold market has rebounded. Although it is still at the low end of the recent sentiment range, the rebound in gold prices is stronger, and the amount of active funds matches the price trend. If the next macro events continue to bring pessimistic news, the price of gold is expected to continue to break through. In the bond market, macro news caused the bond market, which had rebounded not long ago, to pull back. Recently, negative news about the bond market has appeared one after another, but the price of long-term Treasury bonds has not reached a new low. We can intuitively feel the obvious divergence between the two forces, and the market seems to be waiting for some news to give the market an opportunity to form a consensus. The amount of active funds in short-term Treasury bonds has rebounded recently, and some funds are seeking safe havens. Investor sentiment in the cryptocurrency market has retreated after a period of highs, but it is still in the optimistic range, and Ethereum's performance is still relatively strong. Finally, let's take a look at the sentiment and capital flow of major industry sectors in the stock market. Investor sentiment in the entire stock market is still relatively optimistic, although the raw materials sector XLB and the industrial sector XLI are still relatively strong. The active capital volume has not continued to rise, and the trend is slightly weak. Relatively speaking, the active capital volume of the communication service sector XLC is relatively abundant, and whether it can break through the previous high will have a certain impact on the trend of the entire market, which is worth paying close attention to. Also worth paying attention to is the financial sector XLF, where investor sentiment and active capital volume are both in a sideways state, and it seems to be waiting for news. Investor sentiment in the utilities sector XLU is still relatively stable, and uncertainty is relatively low. In general, most sectors fluctuate within a small range, and the stock market is in an observation period. There are few sectors with obvious trends, and they are all operating within the constraints of the recent sentiment range. The above is the macro content, and then we will enter the micro analysis. Today's stock review includes some news about listed companies worth paying attention to. The first news, according to Yahoo Finance, Google may face a black swan event, and its stock price is at risk of falling by 15% to 25%. This warning comes from Ross Sandler, an analyst at Barclays Bank, and his team. In a report to investors on June 2, they pointed out that if U.S. District Court Judge Amit Mehta finally rules to force Google to divest its Chrome browser business during the remedy phase of the Department of Justice's antitrust case against Google, it will be a major blow to Google. The case originated in August 2024, when Judge Mehta ruled that Google constituted a monopoly in the search engine market, especially the general search and general search text advertising markets. Last Friday, Google and the U.S. Department of Justice completed their final statements in the remedy phase of the case. The Department of Justice argued that the court should force Google to divest its Chrome browser business, share its search data with competitors, and prohibit it from signing an exclusive agreement to set Google as the default search engine for mobile devices and browsers. Barclays analyst Sandler believes that although the probability of Chrome being divested is still low, this possibility has increased in his opinion after listening to the final statement. He pointed out that if Chrome is really sold, potential buyers may be well-funded AI companies such as OpenAI, Anthropic or Perplexity. Given that Chrome has up to 4 billion users and contributes about 35% of Google's search revenue, divesting Chrome is undoubtedly a black swan event for Google. Sandler predicts that if this ruling comes true, it may not only cause Alphabet's stock price to plummet by up to 25%, but its earnings per share may also be hit by about 30%. He emphasized that no one among the investors he has communicated with expected such a radical remedy, so once it happens, the market reaction will be very intense. It is worth noting that despite this significant potential risk, Sandler himself still maintains an overweight rating on Alphabet stock. Judge Mehta is expected to make a final ruling on the remedies in this case in August this year. Google has stated that it will appeal the case. In other news on Monday, Alphabet agreed to pay $500 million and adjust its compliance structure to settle a shareholder lawsuit accusing the company of violating antitrust laws. In the previous trading day, Alphabet's stock price fell 1.5%, and has fallen 10.6% so far this year. This analyst report reveals a potential risk that is low in probability but huge in impact for Alphabet investors. The Chrome browser is not only an important entrance to Google's search traffic, but also a key component of its data ecology and advertising business. The forced divestiture of Chrome will fundamentally change Google's business model and profitability, and pose a serious challenge to its control over digital advertising and internet entrances. The current market does not seem to fully price in this extreme situation. Therefore, once Judge Mehta's ruling exceeds market expectations, such as really ordering the divestiture of Chrome, Google's stock price will inevitably be under great selling pressure in the short term. Even if Chrome is not divested in the end, other potential harsh remedies, such as forcing the opening of search data, prohibiting default search cooperation, etc., will also have an adverse impact on Google's competitive advantage and future growth. This series of legal proceedings has brought continued uncertainty to Alphabet's stock price. Investors need to pay close attention to the final ruling in August and be prepared for possible market fluctuations. Although Barclays analysts still hold an overweight rating on the stock itself, suggesting that their base scenario may not include the worst case of divesting Chrome, this warning highlights the legal tail risk that investors need to be wary of in the context of increasing antitrust scrutiny against large technology companies. Second news. This company is called Rocket Lab USA Incorporated, NASDAQ, RKLB, which is the world's third largest space launch services and space systems company with a market value of approximately $3 billion, focusing on small satellite launches and space technology development. The company is headquartered in California, USA, and has multiple launch sites, including the Mahia launch site in New Zealand. Rocket Lab's main customers include commercial satellite operators and government agencies, and it is committed to providing high-frequency, low-cost orbital launch services. Recently, Rocket Lab successfully completed its 65th Electron rocket launch mission, successfully sending Black Sky's third-generation Earth observation satellite into a low Earth orbit of 470 kilometers. This is the 7th successful launch of the Electron rocket in 2025 and the 10th cooperative launch of Black Sky since 2019. This full stream ahead mission was only 16 days away from the last launch, demonstrating Rocket Lab's fast and efficient launch capabilities. The mission used Rocket Lab's self-developed motorized light-band satellite separation system, further consolidating Electron's position as one of the world's most reliable small orbital launch vehicles. In 2025, Rocket Lab plans to complete 4 launches for Black Sky, showing strong customer stickiness and market recognition. Overall, Rocket Lab has consolidated its leading position in commercial space launches with its continued high success rate and fast launch rhythm. Investors can pay attention to the development progress of its future New Neutron rocket and the growth of launch orders, and the long-term prospects are optimistic. This is a potential stock. The third message. D5e Development Corporation, NASDAQ, DFDV, a blockchain technology company headquartered in Boca Raton, Florida, focuses on asset accumulation and decentralized financial business of the Solana ecosystem. The company's market value is approximately $100 million, and its major shareholders include several institutional investors. As the first U.S.-listed company to adopt Solana as a core asset reserve strategy, D5e Development is committed to participating in the growth of the Solana ecosystem and creating investor value by holding and staking SOL tokens. According to the latest announcement on June 2, 2025, D5e Development achieved a record purchase of Solana tokens in May 2025 and now holds a total of 621,313 SOLs, a significant increase from before. The company has established a new verification node partnership with Bonk, Solana's largest memecoin community, further expanding the verification network. At the same time, D5e Development signed a strategic letter of intent with Kamino Finance, Solana's largest DeFi lending agreement, to integrate its liquidity pledge token DFDV-SOL. In addition, the company has launched a new investor communication blog platform to improve transparency and information disclosure quality. These developments show D5e Development's active layout and deep involvement in the Solana ecosystem, strengthening its position as the leader of Solana asset management. Investors should pay attention to the risks of the company's high concentration in the Solana ecosystem and the impact of crypto market fluctuations on the value of its assets. Since Trump took office, the cryptocurrency sector has continued to usher in good news, and related new asset reserves and management companies have also ushered in a wave of investment booms. Friends who are interested in this new track can pay more attention to such companies. Finally, it is our trading operation display today. Next, it is the operation display of strategic trading. It should be stated that, this strategy does not fully consider the impact of the current market news, it is only an operation display under the internal rules, not an investment advice. First, the ETFs of major U.S. stock indexes, ETFs of related industries and concepts, and major ETFs in other countries and regions are modeled and analyzed. Today's trading operations are as follows. Stocks purchased. FAN, reference price 17.22. Stocks sold. None. Stocks held. IYH, reference price 55.56. EWU, reference price 40.29. FXY, reference price 64.58. In the past year, the strategy has outperformed the S&P Fund SPY by 3.84% in this type of stock. We then modeled and analyzed the top 200 stocks in the S&P 500 index, and today's trading operations are as follows. Stocks bought. None. Stocks sold. None. Stocks held. Broadcom, reference price 248.71. WM, reference price 242.1. In the past year, the strategy has outperformed the S&P Fund SPY by 33.46% in this type of stock. Next, modeled and analyzed the top 200 stocks in the S&P MidCap 400 index, and today's trading operations are as follows. Stocks bought. Wing, reference test price 349.1. ELF, reference price 113.77. Stocks sold. None. Stocks held. WWD, reference price 218.19. In the past year, the strategy has outperformed the S&P Fund SPY by 37.45% in this category of stocks. Finally, we modeled and analyzed the top 200 stocks in the S&P Small Cap 600 index, and today's trading operations are as follows. Stocks bought. None. Stocks sold. None. Stocks held. ATI, reference price 80.77. COM, reference price 96.91. In the past year, the strategy has outperformed the S&P Fund SPY by 13.06% in this category of stocks. The above content is just some perspectives for observing the market, not all of the real world. Please integrate valuable information from all aspects and invest and trade in combination with your personal style. Good luck.